In 1952, the average American household spent roughly 4% of their annual income on going to the movies. Not popcorn, not concessions, just the ticket. 4%. That was significant money for a family earning maybe $5,000 a year. And yet, they went. Every week, sometimes twice a week. Today we tell ourselves that movie theaters died because streaming happened, because Netflix made it free, because people got lazy. But that story is incomplete. It misses something fundamental about how movie theaters actually worked as a financial machine, something that began breaking down decades before Netflix even existed. This is the story of the unexpected reason movie theaters collapsed, not the one you think. The collapse of American movie theaters wasn't really about movies at all, it was about real estate. Specifically, it was about what happens when the land beneath your theater becomes worth more money standing empty than operating. Let me show you the numbers. In 1960, a movie theater operator in a suburban location might own or lease roughly 15,000 square feet of building space. The theater itself, the auditoriums, the lobby, the projection booth, took up perhaps 80% of that footprint. The remaining 20% was the parking lot and some auxiliary space. The theater generated maybe $35,000 to $40,000 in annual revenue from ticket sales and concessions. But the land that theaters sat on? In a rapidly developing suburb, that same plot was increasing in value at roughly 6 to 8% per year. By 1975, that land was worth significantly more as a shopping center, a strip mall, or even an apartment complex than it was as a movie theater. Here's the uncomfortable part of the economics that nobody discusses. The typical theater owner wasn't actually a theater person. He was a real estate investor who happened to own a theater. The theater was the tenant in his own building. This created a perverse incentive structure. Let's say you owned a 15,000 square foot property that contained a theater. Your annual revenue was $40,000. Your operating costs, staff, utilities, film rental fees, maintenance, property taxes came to roughly $32,000. You were making about $8,000 a year in profit. That's a 20% operating margin, which sounds respectable until you realize it's on a property worth $300,000. That's a 2.6% annual return on your capital. Meanwhile, a real estate developer approaches you and offers $550,000 for that same land. He wants to demolish the theater and build a shopping center that will generate exponentially more revenue per square foot. What do? For most theater owners, the answer was clear: sell, take the money, walk away. The mathematics were merciless. You were tying up massive capital for minimal returns when that same capital could be deployed elsewhere at 15, 18, or even 20% annual returns. But there was another layer to this problem, one that determined which theaters survived and which ones disappeared first. The theaters that died first were not the ones in old downtown areas, squeezed between other buildings on land that couldn't be redeveloped anyway. Those theaters, paradoxically, often survived longer because their land had limited alternative uses. You couldn't tear down a downtown theater and build a shopping center when you only owned the building, not the surrounding properties. The theaters that died first were the ones in growing suburban areas, sitting on large plots of developable land. Those were the golden targets for developers. The land was worth exponentially more for alternative uses, and the owner had the power to do something with it. This realization, that the real estate value exceeded the operational value, began hitting theater owners in the late 1960s and accelerated through the 1970s. It wasn't because people stopped wanting to go to movies, it was because the economic incentive structure made it rational to destroy the theaters. The first wave of demolitions happened in exactly the places you'd predict: the growing suburbs, Westchester County outside New York, Orange County outside Los Angeles, the Chicago suburbs, the Dallas suburbs. These were places where land values were climbing fastest and where developers had the appetite and capital to build large retail or residential projects. A theater that had operated for 20 or 30 years, that had been a community fixture, a gathering place, a piece of the social fabric, could be erased in a month. The wrecking ball didn't care about cultural value, the balance sheet didn't care about nostalgia. And this happened long before anyone was streaming anything. But here's where the story becomes even more complicated, because not all theater owners behaved the same way. Some sold immediately, some held out, and their different choices reveal something important about how real estate economics actually shape American institutions. The owners who held out were typically not real estate speculators, they were people who genuinely cared about running a theater. They weren't maximizing short-term returns, they were operating on a different timeline, one measured in decades, not quarterly earnings, and because they held out, they inadvertently discovered something that would change how we understand the theater business entirely. These operators realized that the actual revenue driver of a movie theater had nothing to do with the square footage of the building, it had to do with scarcity, the scarcity of convenient access to films in an era before home video, cable, or streaming. You couldn't watch movies at home, there was no other way to see them. The theater had a monopoly on that experience. This meant that location mattered, but not in the way the real estate developers thought. It wasn't about maximizing land value per square foot. It was about maximizing the number of potential moviegoers within a convenient driving distance who had no alternative. A theater that stayed in business was one that understood its genuine market, not the richest market, the captive market, the market that had no choice but to come to you because you were the only option. This is where the narrative splits. And this is where we begin to see which theaters actually survived and why. In urban downtown areas, theaters remained because they were convenient and because they had become cultural institutions, movie palaces with elaborate architecture with social prestige attached to going there. The wealthy didn't mind the urban location because they associated it with sophistication. The working class came because it was accessible by streetcar or foot, and there was nothing else to do downtown on a Saturday night. In the suburbs, a different calculation happened. Those early suburban theaters had thrived because suburbs were new, growing, and had no cultural infrastructure. The movie theater was the primary entertainment option. But as suburbs matured and gained their own shopping centers, their own restaurants, their own entertainment options, the monopoly broke. People no longer had to go to the theater, it was one option among many. The suburban theaters that survived tended to be the ones that made a decisive strategic choice. They doubled down on being theaters, not real estate holdings. They invested in better screens, better sound, cleaner facilities. They became destinations, not just convenient alternatives. Those that didn't make that choice, those that treated the theater as a cash cow and deferred maintenance, didn't upgrade, let the facility decline, those theaters found that they had nothing to offer. They weren't the grand palace that conveyed prestige. They weren't the new multiplex with the latest technology. They were just outdated boxes that happened to show movies. And when the real estate developer came with his offer, those owners took it. This creates a paradox worth sitting with for a moment. The movie theater business didn't collapse because of external shocks. It collapsed because of internal economic logic that rewarded real estate values over operational excellence. The incentive structure was backwards. The successful business model was being undermined by the underlying asset appreciation. Most theater owners faced a choice: compete harder to stay in business, which required capital investment and genuine operational commitment, or cash out by selling the land for development. Many chose the latter. It made perfect financial sense for them personally. The aggregate effect was the destruction of thousands of theaters. And this dynamic, where real estate appreciation makes the actual business uneconomical, this wasn't unique to theaters. It would repeat itself across American commerce in subtle ways throughout the 20th century. But let's go deeper into the theater economics specifically, because there's another mechanism at work that most people miss entirely, and it has to do with how movies themselves were being sold. In the 1950s and 1960s, the relationship between studios and theaters was structured around scarcity and sequential access. A major film would be released to only a handful of theaters in each market. It would have an exclusive window, sometimes 8, 10, 12 weeks, before it could move to the next tier of theaters. This created artificial scarcity that benefited both studios and the theaters that got the first-run releases. The economics were straightforward. A first-run theater would negotiate with the studio for a major title. The studio would take 60 to 70% of the box office. The theater would keep 30 to 40%, but because first-run theaters attracted premium audiences and had limited competition, they could charge higher ticket prices and fill seats reliably. A second-run or third-run theater would get the same film months later, but they'd get a worse split, maybe 50-50 or worse. They couldn't charge as much, and attendance would be lower because the film was no longer new, but the economics still worked because your building costs were lower, your location was cheaper, and you had a built-in audience that couldn't access the first-run theaters. This created a natural ecosystem. Different classes of theaters, different neighborhoods, different audience segments, all of it made sense economically. The studio controlled supply carefully, theaters at each level could operate profitably, but starting in the 1970s, this carefully managed scarcity began to collapse. Not from external pressure, but from internal studio economics. The studios discovered something that changed everything. Releasing a film widely and simultaneously across as many theaters as possible actually maximized box office revenue in the opening week. If you put a big film in 500 theaters instead of 50, you captured far more of the audience in the critical first week, before word of mouth could turn negative or the film could lose momentum. This was the birth of the wide release strategy, and it destroyed the entire ecosystem that theaters had been built upon. Suddenly, there was no scarcity, no exclusive windows where a first-run theater had unique access. A major film would play everywhere simultaneously, or nearly so. This meant that a theater in a poor neighborhood or a second-run location could get a major film just as easily as a first-run downtown palace. The effect was immediate and catastrophic for certain theaters. The first-run palaces in downtown areas suddenly lost their scarcity value. They could still charge premium prices because of their architecture and prestige, but they were no longer the only place to see the new release. The secondary and third-run theaters now had access to the same product at the same time, and they could afford to charge less because their overhead was lower. This dynamic combined catastrophically with the real estate pressure I described earlier. You now had two simultaneous forces. 1. The land beneath your theater was worth more for other uses. 2. The product you were selling, movies, was no longer scarce or differentiated. Theater owners who hadn't invested in their facilities suddenly found themselves operating aging buildings in competitive situations with no cost advantage and no product advantage. The margins compressed, attendance declined, the buildings deteriorated further, the temptation to sell became overwhelming. And here's something crucial that the standard narrative misses. The studios didn't actually care that much. The wide release strategy maximized their profits in the short term. They captured nearly all the opening weekend revenue because they took 65 to 70% of the box office. If theaters went out of business because of this strategy, that wasn't the studio's problem. This was a fundamental misalignment of incentives. The studios were optimizing for their quarterly returns. The theaters were running businesses that required long-term stability and capital investment. The studios could take their product anywhere, to new multiplexes, to drive-ins, to small-town cinemas. They didn't need any single theater to survive. Theaters, by contrast, needed a reliable supply of desirable product to justify their existence. The asymmetry was total. So what happened to the film rental fee structure? This is where the economics get even more brutal. As theaters became commoditized, as the distinction between first-run and second-run collapsed, the studios had leverage to demand higher percentages. If they were giving your theater the same film the same weekend as 500 other theaters, you couldn't negotiate. You took their terms or you didn't get the film. By the late 1970s, film rental percentages had climbed to 75, 80, sometimes 85% of the box office. For a suburban theater that was competing on price and convenience, this was devastating. You're only keeping 15 to 25% of ticket revenue. Concessions became your only real margin source. But concessions had their own economics. Your cost of goods was high. Your prices were limited by what the market would bear. And the margins there were real but limited. If a theater was generating $40,000 in annual ticket revenue but only keeping $8,000 after film rental fees, they were dependent on maybe $8,000 to $10,000 in concession profit just to break even, accounting for labor and overhead. This is actually the beginning of a story that continues to today. Once theaters realized that concessions were their primary profit driver, they began raising prices aggressively. Popcorn prices climbed. Soda prices climbed. The entire value proposition began to shift. You weren't paying for the movie experience primarily. You were paying for convenience and concessions. And this too was part of the dynamic that undermined the theaters. When a moviegoer in 1975 realized he was paying $1.50 for a ticket and $3 for a popcorn and soda combo, he started to resent the experience. The economics of running a theater had become so compressed that the only way to make money was to extract it from concessions, which created customer antagonism. There's a subtle cultural shift here. The movie theater, which had been positioned as a luxury outing, an evening of entertainment and escape, began to feel nickel and dimed. The economics that made sense on the spreadsheet created a customer experience that felt extractive and unpleasant. This matters because it's not separate from the real estate collapse and the film distribution collapse. These were all happening simultaneously. The theater was dying from multiple coordinated pressures. Real estate appreciation made the land too valuable for the business. Wide releases made the product undifferentiated and oversupplied. Film rental percentages compressed margins to nothing, Concessions became desperate and visible, which degraded the customer experience. Each of these pressures alone might have been manageable. Together, they were catastrophic. And they were all rooted in economic incentive structures that made perfect sense for individual decision-makers, studios maximizing short-term profit, real estate speculators seeing alternative uses for land, theater owners rationally taking attractive buyout offers, but which collectively destroyed an entire infrastructure. This is the pattern I want you to notice because it repeats across American business history. When the incentive structure of the system becomes misaligned with the long-term survival of the institutions within it, those institutions die, not because they've become obsolete, but because they've become economically irrational to operate. Now, here's what's fascinating. The very mechanism that killed traditional theaters, the wide release, the compressed margins, the real estate destruction, ended up creating the conditions for a completely different theater model to emerge. And understanding that model reveals something crucial about why some theaters survived while most didn't, and what they were actually selling all along. But before we talk about survival, we need to understand what theaters stopped being, economically speaking, the moment the studio system collapsed. A 1950s theater operator thought of their business in a specific way. The movie was the draw, the loss leader, if you will. The studio set the ticket price nationally. The theater took a percentage, but not a large one. 30 to 40% of ticket revenue went back to the studio, sometimes higher for blockbusters. The real profit, the true margin, came from concessions. Popcorn, candy, soda. That's where a theater made money. That's what they were actually in business for. The economics were simple and elegant. A large popcorn cost maybe 20 cents to make. You sold it for 75 cents or $1. The margin was beautiful. Soda was similar. Markup on candy was exceptional. A theater that could pack 500 people into a show and get 60% of them to buy concessions was essentially printing money on the concession side. The ticket was just the mechanism to get them through the door. This model worked for 50 years because it aligned with how people actually experienced going to the movies. It was an event, you got dressed up, you went as a family or with a date, you arrived early, you sat in a nice seat, maybe you paid a quarter extra for an aisle seat, you bought refreshments, you watched the movie, you left. The whole experience took 3 hours. It was a night out. The cost structure that made this work was built entirely around one assumption: that the theater's real profit came from volume, from moving a lot of people through the doors, from selling them a lot of concessions, and from keeping the operating costs of the building, the staff, and the projection booth lean enough that the margins on food and drink more than compensated for the thin margins on tickets. By the 1980s, that assumption was becoming dangerous. The studio's new strategy, wide releases, saturation booking, changed the game completely. A movie now went to 2,000,000 theaters simultaneously. That meant every theater had the same movie. That meant competition for ticket sales between theaters in the same town, sometimes on the same street. That meant the studio could set a higher ticket price nationally, because demand was now artificial and concentrated. The studio was no longer splitting the risk of a bad film across time. They were concentrating it across space. Every theater was now a gambling chip. And here's the financial problem that created. When every theater in a 20-mile radius has the same blockbuster movie, ticket sales become a zero-sum game. You're not expanding the pie, you're dividing it more ways. So theater owners started competing on amenities. They built more screens, they installed better projection technology, they upgraded their lobbies, they hired more staff to manage the complexity. Every one of those improvements increased the cost structure. Meanwhile, concession prices were still bound by consumer expectations. You couldn't charge $5 for a large popcorn in 1985, the market wouldn't bear it, but your labor costs were rising, your real estate costs were rising, your utility costs were rising, you were building bigger buildings with more screens, which meant higher fixed costs whether you filled those screens or not. So the margin on concessions, that beautiful 60% markup that had sustained theaters for decades, started getting squeezed from both sides. Costs went up. Revenue per customer stayed flat or even declined, because attendance was already dropping in many markets. Some theater chains responded by raising concession prices aggressively that only accelerated the shift toward home viewing. Why pay $8 for a soda at the theater when you could buy a 2-liter bottle at the grocery store for $1? The economics had inverted. The movie, the thing that had always been the loss leader, was now becoming more important to revenue because ticket prices were the one price point they could actually control and raise. Studios had given theaters permission to charge more for tickets because the studios wanted their percentage to grow. A $3 ticket that goes $1 to the studio and $2 to the theater isn't as attractive as a $7 ticket that goes $2.80 to the studio and $4.20 to the theater. So ticket prices doubled, tripled, quadrupled over 30 years. But here's what's crucial: raising ticket prices destroys the entire premise of the theater business model. If the ticket is expensive, people don't come as often. If people don't come as often, they don't buy as many concessions. The concession margin, which was supposed to be the real profit, starts to decline in absolute terms, even as a percentage of revenue. A theater doing 500 admissions at $2 per ticket, with a 60% attachment rate to concessions, generates way more concession revenue than a theater doing 200 admissions at $7 per ticket, even if the concession attachment rate stays the same. The studios understood this perfectly. They didn't care. They were extracting maximum revenue per release, per theater. The theater's long-term viability wasn't their concern. If a theater couldn't sustain the cost structure required to operate in this new environment, the real estate, the screens, the staff, the technology upgrades, then it closed. Another theater would open to replace it, probably owned by a larger chain that could absorb losses in some locations by profiting in others. This is the crucial economic pivot that destroyed the traditional American theater. The business model stopped being about filling seats and selling food. It became about extracting maximum revenue from each release in a concentrated national time frame. That required different real estate, bigger buildings in more expensive locations, with more screens. It required different staff, more ushers, more managers, more people per screen than the old single-screen or double-screen theaters ever needed. It required different technology, projection systems that could be upgraded every 5 years, sound systems that had to be replaced to compete with competitors, and it completely severed the relationship between the theater and its community. A single-screen theater in a small town wasn't just a business. It was an institution. The owner knew the regular customers. The staff might stay for years. The building itself had character, history. When that theater closed, something was lost that couldn't be replaced. The multiplex theaters that replaced them, owned by national chains and designed to be interchangeable across dozens of markets, had no such relationship. You could close one and open another in the same metro area, and the financial impact would be absorbed by the portfolio. The individual theater meant nothing. It was a revenue node in a network. Now, what's fascinating is that this is exactly the moment when a completely different type of theater began to emerge and, in some cases, thrive. And understanding why requires us to look at what the traditional multiplex had forgotten it was actually selling. It wasn't just the movie. It was never just the movie. It was the place itself. The experience of being somewhere that felt permanent, staffed by people who knew your name, who had invested their own capital and reputation into the physical space you were sitting in. And that distinction between a theater as a product delivery system and a theater as a place became the fundamental economic dividing line of the 1980s and 1990s. The independent single-screen theater, the kind that might serve a town of 12 to 25,000 people, operated on fundamentally different economics than the multiplex network. And this is where we begin to see the real fracture in American theater revenue. A single-screen operator in 1985 might book films on a percentage split, just like the multiplexes did. 70-30 split with the studio in week 1, shifting to 60-40 by week 3. But because they were showing one film at a time, and because they typically had 1 or 2 showtimes per evening, their entire operational cost structure was radically different. Rent, say $2 to $3.0000 a month for a modest building in a small town. Labor, 1 manager, 2 or 3 projectionists, 4 to 6 concession workers. Utilities, simple. Insurance for a single-screen building, manageable. A single independent theater might operate on a total monthly overhead of $8 to $1.200, depending on the town and the building condition. The revenue math was simple. If a film averaged, say, 120 paid admissions per showing on a Friday and Saturday night, and 40 to 60 on weeknights, that single-screen theater might gross $2.50 to $3.500 per week in ticket revenue. The studio took their cut, typically 50 to 60% on established films, leaving the theater with maybe $1.200 to $1.700 per week from tickets alone. That's tight. That requires concessions to work. But here's what changed the equation. In a small town, concessions didn't feel like an extraction. They felt inevitable. You got popcorn at the movie, everyone did. Parents knew the price, kids looked forward to it. A single-screen theater's concession economics were straightforward. popcorn and soda made up roughly 85 to 90% of concession revenue. A small bag of popcorn cost the theater roughly 35 to 50 cents to produce. Kernels, butter, oil, salt, the bag itself, it sold for $1.50 to $2. A medium soda cost the theater maybe 20 cents in syrup, cup, and lid. It sold for $2.50 to $3. That's a gross margin of 60 to 75% on concessions. A theater that moved 60 to 80 concession items per showing, across a few hundred ticket holders, was pulling in another $8 to $1.00 to $1.00 per week in gross concession revenue. Half of that, $4.00 to $6.00 per week, was profit. So a modest single-screen theater was clearing, in a good week, roughly $1.00600 to $2.300 in total revenue after studio cuts and product costs. In a slow week, perhaps $9.00 to $1.200. That had to cover $8 to $1.200 in monthly fixed costs. That's a theater that needed roughly 8,000 to 9,000 admissions per month, or about 2,000 to 2,250 per week, just to break even on overhead. In a town of 15,000 people, with competition from one or two other entertainment options and the draw of television at home, that was achievable. Barely. But here's the detail that the multiplex had optimized away. The single-screen theater's survival depended on a film being a genuine draw in that community, not a product offering, a draw, a must-see. When E.T. came to the single-screen theater in the small town, people came. They brought their families, they came back twice, concessions spiked. When a weaker film arrived, the theater felt the pain directly and immediately. There was no second screen to catch overflow or to hedge the bet. One weak film in a 4-week month could push a small theater into loss. This meant that single-screen theater operators in the 1980s and 1990s began to behave very differently from multiplex chains. They became curators, in a sense. They had to understand their audience deeply. They booked films that would play well in their specific community, not films that fit a national release strategy. A small-town theater might hold Back to the Future for 6 weeks, not 2. They would understand that a Clint Eastwood Western or a Sylvester Stallone action film would draw their demographic, middle-aged men, working-class families, while a teen-oriented comedy might underperform. They tracked competitor activity obsessively, they advertised in the local paper, they sponsored local events, they became part of the civic fabric in a way the multiplex, by design, never could. The economics of this approach were actually quite different from what the multiplexes had created. Where the multiplex operated on volume and standardization, same experience everywhere, maximum seat count, rapid turnover, the single-screen theater operated on intimacy and specialization, but both were sustainable models. The multiplex could generate revenue from sheer scale and average performance. The single-screen theater could generate revenue from deep, repeated patronage and cultural significance. What neither model anticipated was that the actual collapse of theatrical revenue wouldn't come from the multiplexes being too efficient, or the single-screen theaters being too boutique. It would come from something far more fundamental: the economic viability of the theatrical experience itself, as a percentage of total entertainment spending, began to shrink. And it shrank for reasons that had nothing to do with how well either type of theater was run. Home video rental, cable television, and eventually pay-per-view began to offer a competing experience that had its own economics. A VCR in 1985 cost between $4 and $6, expensive, but no longer absurdly so. A videotape rental was $2 to $3. Popcorn at home was pennies. The concession economics that had kept theaters alive, that 60 to 75% margin on candy and soda, suddenly felt like a premium you were paying to sit in public with other people. And that's the invisible turning point that neither the multiplex operators nor the independent single-screen owners saw coming with sufficient time to adapt. The revenue per viewer, in absolute terms, remained relatively stable, but the total number of viewers who chose to pay that revenue per viewer, who chose to go out, began to contract. A theater might have had 500 admissions on a Friday night in 1980. By 1990, the same Friday night, the same town, the same film, might have 350 admissions. The economics didn't change. The denominator changed. And when the denominator contracts while your fixed costs remain the same, rent, insurance, projectionist salary, building maintenance, the profit margin doesn't just shrink, it inverts. A theater that had been running at 15 to 20% net profit margin in 1982 might be running at 2 to 3% by 1992. And at 2 to 3%, you're one bad month, one weak film cycle, one competitor opening nearby, away from insolvency. This is where we need to pause and recognize something crucial about the multiplex versus the single-screen divide in the context of this larger collapse. The multiplex, by its nature, had already begun to diversify its revenue, not from different film types, but from different experiences within the same building. A multiplex with 6 screens could have a major studio release on 2 screens, a mid-tier film on 2, and a smaller release or re-release on 2 more. If one film underperformed, 3 others potentially compensated. That's not strategy, that's just mathematics. But it was a mathematics that temporarily allowed multiplexes to weather the contraction better than single-screen theaters could. The single-screen theater, meanwhile, had nowhere to diversify. 1 film, 1 screen, 1 bet per week. And as admission numbers began to contract, that became a liability rather than a charm. This is where the economics of the 1990s and early 2000s became genuinely brutal, because the industry's response wasn't to slow down the multiplex expansion or to protect single-screen theaters. The response was to double down, to build more multiplexes, bigger ones, more screens per location. Because if you're a theater chain, you understand that admissions are declining overall. The rational response from a business logic standpoint is to grab market share from competitors before they grab it from you. If Cinemark or AMC doesn't build a multiplex in the suburban market north of the city, Regal will. And if Regal takes that market, Cinemark loses not just new revenue but existing revenue from other locations as that market's viewers shift their theater-going habits. It's the classic tragedy of the commons in economics, individually rational decisions that collectively create an irrational outcome. Every theater chain knew that the total market was contracting, but every chain also knew that losing market share would be worse than competing on the same shrinking pie. So they built, and built, and built. And the single-screen theater in most American towns simply couldn't compete. Not on price, the single screen was often cheaper. Not on convenience, the single screen was usually downtown, while the new multiplex was in the mall with other shopping and eating. Not on technology, the multiplex had larger screens, better sound systems, more modern facilities. But most of all, the single-screen theater couldn't compete on choice. Why go to one screen and sit for 3 minutes deciding whether to buy popcorn, when you could go to a multiplex with 8 screens, grab concessions, make a choice between multiple films, and experience modernity? By 1995, most American single-screen theaters had closed or converted. The ones that remained were either in very small towns, fewer than 10,000 people, where a multiplex wasn't economically viable, or they were in specialized positions, like revival houses, art film venues, or nostalgia-driven historic theaters that attracted tourists. If you want to understand the complete financial picture of how this transformation happened, the actual margin erosion, the theater attendance curves, and the expansion strategies that sealed the fate of an entire class of American business, that's all broken down in our detailed guide, available in the description and pinned comment. But the real question isn't what happened to the theater that closed, it's what happened to the economics of the ones that remained. Because the multiplex victory wasn't a stable equilibrium, it was a temporary plateau before another collapse entirely. By the year 2000, the average multiplex in the United States had 10 to 14 screens. By 2005, that number had risen to 12 to 16. By 2010, 14 to 18. The average theater size was growing, the number of screens per location was growing, and the investment per multiplex location was growing. A new multiplex in 2000 cost roughly $4 to $5 million to build and equip. By 2010, that same multiplex cost $6 to $7 million. The capital requirement was rising, the fixed costs were rising, and the market that had to support those costs was continuing to shrink. This is where we encounter a completely different aspect of theater economics that changed the entire business model: technology. Specifically, the transition from film projection to digital projection. And this wasn't just a technical upgrade, it was a fundamental shift in who controlled the revenue model. For decades, the studio and the theater split revenue based on admissions. The theater paid the studio a percentage of ticket revenue, but with digital projection, the studio could now enforce a floor, a guarantee. A theater had to guarantee a minimum revenue payment to the studio, regardless of how many tickets it sold. If a film was a blockbuster, the percentage split might have been higher. But if a film underperformed, the theater was already committed. It had guaranteed the studio a minimum. The theater bore the downside risk entirely. This is part 3 of a larger script. Continue naturally from here. Do not conclude, do not add CTAs. You will receive part 4 instructions separately. The mathematics of this shift were brutal. A theater owner in 1975 could negotiate with a studio. They could say, "I'll take Jaws, but only if you give me 70% of the gross. The studio needed the theater. Distribution was still a bottleneck, but by 2010, a theater owner sat down with a studio representative and heard a different proposition entirely. We're guaranteeing $3 million minimum on opening weekend, or we're giving the film to your competitor instead. The negotiation was over before it began. The theater owner had already lost. What made this arrangement even more damaging was the collapse of the theater's own leverage over time. In the 1960s, a theater in a medium-sized city could program its own films. It could hold a blockbuster for 12 weeks if the audience kept coming. Studios competed for that screen time, but multiplexes changed the game. Suddenly, a single theater company could program 20, 30, or 40 screens across a city. The studio could dictate that if you wanted the Marvel film on 8 screens, you also had to take 5 other films that might not perform. The bundling was invisible but total. A theater owner couldn't refuse. The alternative was losing the entire franchise. This is where concession sales became not just important but existential. By the 2000s, a theater's actual margin on ticket sales had compressed to almost nothing. An AMC or Regal theater might keep only 10 to 15% of every dollar spent on admission, the rest went back to the studios. But popcorn, soda, candy, those items had a cost structure that hadn't changed in 30 years. Popcorn kernels were cheap, oil was cheap, cups and containers were cheap. A large popcorn that cost the theater $2 to produce sold for $8. That was a 75% margin. It was the only place in the theater where the owner could actually control profitability. But this created a trap. Theaters were no longer in the business of showing films. They were in the business of selling snacks. The film was the mechanism to get people in the door. Everything else was secondary. This inversion of purpose changed how theater owners thought about their own business. They couldn't afford to show films that appealed to serious audiences if those audiences didn't buy concessions at high rates. They couldn't program repertory seasons or classics. They couldn't take risks on independent films. They had to show what sold popcorn. Explosions, fast cuts, loud sound, spectacle that made people want a $20 experience at the concession stand. And when the pandemic hit in 2020, this entire structure collapsed. Theaters couldn't open, no admissions, no concessions. But the mortgage payments didn't stop. The rent didn't stop. The insurance didn't stop. For months, theater owners were burning capital with zero revenue. Some had been operating on razor-thin margins for years. They had no reserves. They had no equity. They had debt structured around the assumption that people would always come back. When they didn't, the debt structure broke. What emerged from the pandemic was a fundamentally different business model. Streaming had been accelerating before 2020. Netflix had been stealing market share for a decade. But the pandemic turned it into an exodus. Major studios released films directly to their streaming platforms. Disney had Disney+, Warner Bros. Had HBO Max. Universal was putting films on streaming the same day they released in theaters. Theater attendance plummeted. In 2019, American theaters sold approximately 1.2 billion tickets. In 2021, at the height of streaming acceleration, that number had fallen to 492 million. That was a 60% collapse in a single year. The theater owners who survived were those who had fundamentally restructured their cost base. They closed underperforming locations. They renegotiated debt. They cut corporate overhead. They stopped trying to be everywhere and instead focused on premium experiences. They raised ticket prices significantly. In 2019, the average ticket price in America was $9.16. By 2023, it had risen to $10.62. That was a 15% increase in 4 years. But the real premium play was in the high-end experiences. Luxury recliners, IMAX screens, Dolby Cinema. IMAX tickets could command $20. Dolby tickets could reach $18. These were margins the theater industry hadn't seen in decades. But this strategy only worked if you had capital to invest up front. Most of the theater chains that had survived the 2008 financial crisis and carried heavy debt loads couldn't afford to upgrade. They had to squeeze every dollar from their existing locations. And that meant raising prices on everyone, not just premium customers. A regular ticket that cost $6 in 2010 was now $9. That price increase was barely ahead of inflation, but it also didn't increase revenue enough to keep up with rising costs. Studios were still taking their cut. Rent was rising. Labor was rising. Insurance was rising. By 2023, it became clear that the American multiplex as it existed in 2010 was extinct. The business model was no longer viable. The chains that had survived had either radically shrunk their footprints or transformed themselves into niche players. AMC went through multiple rounds of restructuring and debt negotiations. Regal Cinemas, which had been the largest circuit in America, closed hundreds of locations. Smaller, independent theater operators fared better in some cases because they had lower overhead and more flexibility in their programming. What happened to the American multiplex, fundamentally, was that the economics of scale that had made it dominant became the economics of its decline. Multiplexes were built on the assumption that you could spread fixed costs, rent, labor, utilities, across many screens and many films. That worked when there was genuine scarcity, when you could only see a film in one place at one time. But the internet destroyed that scarcity. A film released theatrically on Friday could be pirated by Sunday. It could be streamed on a platform subscription by Wednesday. The window of theatrical exclusivity, which had been weeks or months in the 1970s, compressed to days or hours in the 2020s. Theater owners also never fully understood that they were competing not just with other theaters but with the entire home entertainment ecosystem. By 2010, a household could have a 50-inch flat-screen television for $800. They could subscribe to Netflix for $9 a month. They could add HBO for $15. They could invite friends over, order pizza, and have the exact same movie experience as a theater, but at home, for less money, with complete control over the experience. The theater industry's response was to argue that theatrical exhibition was about the spectacle that couldn't be replicated at home. And that was partially true. An IMAX screen is genuinely different from a home television, but the cost of that difference had to be justified by the viewer, and for most of the audience, the convenience of home viewing became a stronger value proposition than the spectacle of theatrical viewing. Especially as home television technology improved. This is why the collapse of the American multiplex wasn't a sudden failure. It was a slow, steady erosion of the economic model. Each year, the margins compressed slightly more. Each year, the studios demanded higher guarantees. Each year, attendance drifted lower. By the time the pandemic hit, the system was already fragile. It just needed a shock to break it. And the shock came. The lesson of the American multiplex is not that theatrical exhibition died. It didn't. Theaters still exist. Films still premiere in cinemas. But the business model that sustained the multiplex, the assumption of reliable, steady attendance, the leverage of scarcity, the ability to extract high margins from captive audiences, that model is gone. What remains is a niche, a premium niche, but a niche nonetheless. Theaters now compete on experience quality, not quantity. They serve audiences who value the communal experience of cinema or who demand the spectacle of a massive screen. But they no longer dominate the distribution of films. That power has shifted entirely to streaming platforms, and the economics of distribution have shifted with it. If you want to understand the full financial architecture of how theaters generated revenue, managed their cost structure across different eras, and competed with changing distribution platforms, our complete guide is available in the description and pinned comment. It goes much deeper into the studio-theater relationship, the mathematics of film rental arrangements, and the specific financial strategies that different chains use to maintain profitability through the decades. The guide will give you the detailed cost breakdowns that this video can only touch on. The story of the American multiplex is ultimately a story about how technological change, market saturation, and shifting consumer behavior can undermine even the most dominant business model. For 70 years, the multiplex was the primary way Americans experienced cinema. It was a machine for extracting value from the public's desire for entertainment. It worked beautifully, until it didn't. And once the model broke, there was no going back. The assumptions that had held it together were permanently shattered. What's remarkable is that this isn't unique to theaters. The same forces that destroyed the multiplex model have been destroying other retail business models across America for the past 2 decades. Department stores, video rental stores, shopping malls, office supply chains. Each one operated on assumptions about consumer behavior, distribution scarcity, and predictable demand that were eventually invalidated. And each one took years to fully fail, creating long periods where the cost structure was broken but the business was still operating. Those are the stories that fascinate me most, the slow-motion collapse, where the financials tell the real story before the headlines do. If you're interested in the hidden financial mechanics behind other iconic American businesses that thrived and then disappeared, subscribe to the channel and activate the notification bell. I publish detailed cost structure analyses on the businesses that shaped 20th century American life. From drive-in theaters and country clubs, to department store empires and small-town newspapers. Each video peels back the surface-level narrative to show you exactly how these institutions made money, where that money went, and what economic forces changed everything. Thank you so much for watching, and I hope you'll join me for the next deep dive into forgotten American business history.